All right, good morning, everyone. It is 8:32 on the morning of January 20th, 2023, and this is my pre-market strategy session. And so the title of today's video is QQQ support at 273-ish for next leg up. And this is the way that I'm seeing things. And actually, sorry to miss you yesterday. So the night before last, I had injured my shoulder somehow. I don't know what I did. I strained it or something, and it was extremely painful. And I couldn't sleep. I think I finally fell asleep at like 4 o'clock in the morning. And so I went ahead and just didn't trade yesterday. I put on some trades. I put on some shorts back here on the 18th. And actually, I put on some shorts on the 17th, but I went ahead and exited them with a small loss just because I didn't want to sit on a loser. I didn't want to sit on a loser overnight. And so then on the 18th, I jumped into a couple of contracts, four puts with a 273 strike. And so then yesterday in the afternoon, I did come in and close those, but I didn't trade the morning session. And so now here we are this morning, and what I'm expecting is the Qs to kind of hang around down low here for a couple days. Although we are opening up 2/3 of a percentage point higher than our previous close. I think the next couple of days are going to hang around in this 273 to the 276 range. We might get a little touch. We haven't officially closed this tiny gap that we had from between the 18th and the 19th, so we might get a touch off of is that 277, the high 277s, almost 278. But I think price is going to kind of wallow around here for just a little bit longer before we make the next move up to touch the top of this gap. Now we've gotten into the gap and we were rejected. Perfectly normal behavior. So the way that it looks to me that things are going to happen is we're going to spend a couple of more days down here in this price range to, I don't know, whether it's to scare the bulls or to suck in some bears, whatever it's going to be, for the next leg higher. And the next leg higher ought to take us to the top end of this range here, which is above the gap that I have on this chart. It occurred between the close on the 14th of December to the open on Thursday, the 15th of December. And that price range is between the 282.33 to 286.51. And the test, the Qs are going to come back and fill that again at some point. I think it's going to be sooner rather than later. Hang on a second, I've got somebody at my door. I'll be right back. Hey, good morning. No, I don't. Yeah, I don't know who it is. Good luck. No worries. All right, everybody, sorry about that. Let me get clipped back in here. Okay. Yeah, they're doing some construction on the road out in front of my office, and somebody's parked where they need to do the construction. Okay, so yeah, the Qs are going to come up and fill this gap. I think it's going to be sooner rather than later. The way that I'm seeing things, there's just a small amount of support and resistance down here at 273. Actually, I shouldn't say small amount, actually, because if we go back, I'm going to delete this line right here. I'll put it back later. But if you look back, this 273-ish area, right in here, let's go right here. Right there, this area right in here, I'd say between, yeah, it was at 277 and 273. It's actually been kind of a long-term sort of, we went up above it a little bit, came down, went back up above it again, came down, popped back up above it, stayed above it for a while, then came back down. Now here we are testing it again. What I think is going to happen is I think that in the short term we're going to see a bear market rally. We are in a bear market. I mean, this is more than 30% from the top. The trend is your friend. The trend is definitely bearish. These things reverse at some point. I don't think that this is going to be a reversal for an extended new trend higher. I think that this is just going to be what I hate to call it a suckers rally, but I mean, I think that we are about to enter into a rally that's going to get higher than most people anticipated, and probably even higher than I anticipate. If we break through this top resistance line right here, it wouldn't surprise me, this top red line right here, and then go a little bit higher. I think it'll pull a lot of people, a lot of money, a lot of retail investors and traders into bullish stance. And it's all just to set up for another leg down when the 10-year, 2-year normalizes again. So the 10-year, 2-year here, the pink line is the zero line. It's inverted. So the 2-year yield as of right this moment is yielding 734 basis points more than the 10-year right now. And so that's inverted. The 10-year is supposed to always, I say always, but the 10-year is supposed to yield more than the 2-year. You're supposed to get a higher return for investing in 10 years time than 2 years time, and right now is not the case. Let me go to the monthly chart here. This is something that if you've watched my channel before, I've covered almost every day for the past at least probably close to a year. We have these inversions, and it's when the yield curve, this 10-year, 2-year yield curve inversion normalizes again, that's when we see the crashes, right? And so the 10-year, 2-year inversion can be here for 12 to 18 months. And right now I think we're going into month 7. 1, 2, 3, 4, 5, 6. Yeah, we're going to 7. This is the 7th month into the inversion. And so somewhere between 12 and 18 months, like I said, which puts it at 5 to 11 months from now, you can anticipate seeing this yield curve normalize again, and that's when we see the next big leg down on the Qs. Human behavior and sort of behavioral psychology kind of plays into the market big time. And so I do believe that we are setting up for another big leg down when that thing normalizes, but will it be a leg down that breaks into new lower lows? Or does it, turn around after it normalizes? Does it turn around and go higher? I happen to think that actually we're headed to new lower lows once this 10-year, 2-year normalizes again. We can expect to see new lower lows on the Qs at that point, so, and that would bring us down into. And actually, let me go to the Fibonacci here. If things play out according to the way they have in the past, our past examples, then we're looking at a 50% retracement from the top, which puts the Qs down at 214, and even possibly 60+% reversal from the top, which puts us down to 169, 170, something like that. But that's not right now. That doesn't happen until at some point when the 10-year, 2-year starts to normalize from its inversion again. In the meantime, the thing can be bullish. I mean, there's so much in the way too of negative news. We're not out of the woods. And actually, I'm going to open up another chart here. And the reason I'm opening up another chart is because if I do it on one of my previous charts, it'll kind of mess it up. Let me go to indicators. There's an indicator here that only allows me to chart on a monthly basis, and that's PMI. So here we are on PMI, and you see I get this little message up right here. We're still below 50 on the PMI. I believe this is the Chicago PMI. And below 50 is an indicator of a contracting economy, right? And so we don't actually really start to recover, like we don't start getting bullish. The economy isn't really considered bullish until this is above 50. That's a growing economy. Right now, we are in a shrinking economy. And let's see, do I have, this is the, okay, here's the PMI, all right. This is the Labor Bureau of Labor and Statistics PMI, and it's also in contraction. It's below 50, and it was just a few months ago here. Let's see, March of 2021, almost a year ago, almost 2 years ago. Wow, went from 64.81 to a huge. This is an enormous move down here. So the Purchase Managers Index is showing a contracting economy, and so in the meantime, though, even though there's all this negative news out there, I mean, this is negative. This is a leading indicator. The PMI is a leading indicator, as well as Chicago PMI is a leading indicator, and it's saying that we're in contraction. Recession. We're probably already in a recession, or who knows. Anyway, these storm clouds. If you hear about all the economic storm clouds and everything, this is it. These are the indicators. The inverted yield curve plus the PMIs below 50. And there are a couple other things too, and I can't think of them right off the top of my head. The economic condition does not look good. But until whatever crisis it is that really reveals itself for sort of the cause of all this, the markets can be bullish. And so, for the short term, at least, what I was expecting for a pullback. So. Starting back here in early January, I was like, okay, here's the support zone for leg up, which I think is going to be a bear market rally, and then we moved up something close to 9% here from the bottom right here. Let's see, let me chart this real quick. 9.35% up. After a 9.35% move up, I mean, nothing moves up in straight lines on the market. You expect a pullback. So here we got a pullback. I think we're going to spend a couple days in this price range, and then we'll start breaking past this high right here that was put in, this most recent high that was put in on the 18th of January. Short term, very short term, I'm neutral, and then after we spend a couple of days in this price range, I'll be looking to get bullish again, and I've taken profits on this short-term pullback already. So I'm really kind of going to sit tight. I'm going to sit tight until we start breaking above this price level right here at 283.11, because I can be wrong. So if we start breaking back down here real soon to these levels and go below this Fibonacci level, if we do that instead of getting the rally that I think we're going to get, then I'm going to be very bearish. If we break down below this Fibonacci right here and hold below it, the next level down is 215 on the Qs. So part of being a successful trader is knowing when you're wrong, admitting to yourself when you're wrong. Having the intestinal fortitude to say, okay, my bias is wrong. That's why it's good for me, at least, to identify my bias, so I can know when I'm wrong. Because if I know I'm wrong, I get to change my mind and I get to be right. I cut losses and then get in the direction that trade the chart that's in front of me, get in the direction that the market is going. All right, so pre-market here, I think we're a little bit overbought. Yeah, we're overbought on the 10-minute, and we're coming we're in the middle of things here on the 1 minute. On the VIX, let's see, it should be pretty much inverse. Yeah. Pretty much inverse. The 10-minute isn't in overbought. The 10-minute is neutral on the relative strength index on the VIX, and neutral on the 1 minute. So actually tends to be bullish. Let's see what kind of news they have here. Headline: Wall Street falls as recession fears mount. Blah 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 blah. Let's see what the headline is here. Equities need a breather. Tread water for the next couple of days. How about that? Look at that. I would usually say blah, blah, blah to that too, but that's kind of the way that I feel things are going to happen for the next couple of days. Funny how that works. All right. So yeah, really interesting thing happening in Bitcoin here. This is a huge move up, and this move above 21,000 is a big deal. The support, previous support here. Let me open this up. Was back here at roughly 19,000, the mid 19,000s. So a breakup back above that is really encouraging. There's definitely some price resistance. Bitcoin is definitely some price resistance right here. And these temporary run-ups like right here, could be a combination of a short squeeze. There was a theory out there that Bitcoin was being used in order to pay off some hackers that had hacked into the FAA flight system, the NOTAM system, and the same thing happened with China and in Canada. And so who knows? But a really, I don't know. I don't know what Bitcoin's usually a pretty good leading indicator in the short term of which way the equity markets are going. Tesla. Now, this is an interesting chart here. Let's look at this real quick. So let me kind of squeeze that together. You can see this enormous amount of volume right here in Tesla. Now, that to me looks like a bottom. That to me, when you start getting a move down and then it settles out right here, and there's a huge, the volume went up incredibly here. Let's see, where's, 231 million shares. Back here we're, 100 million shares or so were traded a day, 90, 75, 80, 60 million shares have been traded back in here. We've had this roughly week or two of huge volume, and typically that means lots of sellers have come in. It's somewhat of a capitulation, somewhat move here, and things are about to go in the opposite direction. I can see Tesla moving, like this for a while. Great chart. That's great, right? You can really count on that one. But that's the way it looks to me. It looks like we are getting some support and a bit of capitulation right here at this bottom. And that it tends to mean prices will drift up for a while. And that's going to be good for the tech sector, for Qs. Tesla isn't considered a car company, it's considered a tech company. All right, everybody. So that's pretty much what I'm doing for today. I'll probably be sitting on my hands for the next couple of days and then look for things to get bullish after after the Qs find support in this price range for a couple of days. And yeah, that's kind of the way I'm seeing things. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at Monday morning's strategy session. Thanks for tuning in. I am out.